Welcome to season 2 and session 2 of Market Thinkers. Morning, Drew. Morning, Andrew.
Morning, Jamie.
Morning, Jamie.
We've dedicated this whole season to big investment themes, and we'll be focusing our discussion on some of the most important technological, demographic and societal trends that are occurring around the world. We'll be speaking to an expert each session that will help us explain the theme, the risk and the reward. History has shown identifying themes as a major or a powerful contribution to any investment committee. In fact, that's how Drew and I start our investment committee every quarter or every month. We talk about what are the big themes. And this week we're talking about inflation, the boogeyman, if you like. Inflation's been a part of our investment committee or input into our investment committee for a long time. And I really love, and I've been quoting this for a long period of time, but Ronald Reagan's quote about inflation. And it goes like this: inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. And why? We're all probably a bit young on this call to understand inflation or experience inflation, but inflation was at its height in the 1970s. It went from 1973 to 1983, and they had two cycles, peaking at 12% at the end of 1974, and the second one topping out at 15% in 1980. The direct effects of inflation, as we all know, it erodes purchasing power. And if we go back to 1970, a basket of goods that you could have bought in 1973 for $40, by the time you got to 1983, you would have needed $100. Now, just imagine if you were retired on a set pension or a set amount over that period of time. It doesn't just affect that, it affects everything. So once inflation goes up, it affects, creates uncertainty in terms of purchasing choices, in terms of economies, in terms of how do you price assets. So it's always been a theme. At the moment, I saw it was on the front page of the Financial Review today, someone talking about inflation. So we thought Andrew Canobi from Franklin Templeton, a great relationship with Andrew, and he's what we think is a preeminent bond manager in Australia and has always been thinking about this. We thought it was a great opportunity to talk to Andrew about inflation, how we might equip portfolios for inflation and the effects that inflation have. So Drew, do you want to kick off some questioning?
Yeah, of course. I'm not sure if we brief these before you do, Andrew, but we had a couple of 4 short questions. Pass, true, false, or pass. The first one was, when was the last time I think Aussie inflation exceeded 3% for more than a quarter? I looked up the answer if we need it.
Well, it's been more than 7 years since inflation was in the Reserve Bank's target zone. So I'm going to say 2014.
Yep, I think you're right too. I was Googling not long before this as well. The other one is more general. So long duration assets are an underappreciated risk in portfolios. True or false?
True.
True. That was an easy one for you. The greatest risk reward opportunities in March, for March and for 2021 going forward, corporate or government debt?
Corporate.
Corporate. And the likely source of most returns is very specific in 2021, credit duration or liquidity risk?
Probably duration, but I would qualify that by saying not necessarily just from being overweight or long, but tactically adjusting it.
Excellent. And should we get a bit of, I know we get is it from the Fixed Income Desk newsletters every week? You're pretty clear on your views on monetary policy and inflation. Could you give us a bit of a background on your experience? I heard someone talking last week that at the moment, this is bond managers' time to shine. Falling interest rates for decades is easy.
Yep.
Easy,
Yep.
We'll still say it's easy. Are you excited? Is this what you're expecting? Is this a good period for you? You
can really smell the animal spirits in the air in bond land at the moment. And I think, the sort of recent weeks, certainly February, we saw literally the worst calendar month performance for the general Australian bond benchmark that most people look to in history. So worse than any calendar month in 1994, for example. Such was the move higher in yields. With duration of that index being more than 6 years, it was a very, very significant, loss, about 3.6% of that benchmark. So what is going on? Is this an inflation kind of scare, if you like? And I think we can basically say the markets have been looking at economies reopening, vaccines being rolled out, growth and activity indicators looking okay, and the conclusion being reached, inflation must be coming. The central banks are going to have to abandon this view that they're on hold for a 3+ year period, there's no inflation, and bring forward some monetary tightening ahead of that period. And that's basically what happened in the course of the last few weeks. So in terms of numbers, the market started to imply that the Reserve Bank would raise rates by nearly 100 basis points over the next 3 years because their inflation target would start to be met. Now, I can talk about why that's quite unlikely, if you like. The simple fact is the low-hanging fruit is genuinely being picked within this post-COVID recovery. That is true. So we are seeing a lot of pent-up demand come out. But the central bank, both here in Australia and around the world, have been very clear that they are not going to raise rates because consumption is picking up, because house prices are strong, or any of those other things that are good in their own right. They are going to keep monetary policy where it is and possibly even ease further until they see wages growth return to levels that they think are consistent with their measure in inflation.
So do they maybe think the economy isn't as strong? They're waiting for a JobKeeper or something? Is that
correct? So let's put some numbers around that. If you go back to the COVID pandemic, unemployment in Australia got down to around 5%. Wages growth was barely 2%. Unemployment's now 6.4%. Wages growth most recently is around 1.4%. They believe that wages growth needs to be sustainably, not just momentarily, 3.5% to 4% per year to be consistent with them meeting their objectives of core inflation being 2 to 3%. Now, the last time wages growth was 3.5% to 4% was towards the start of the last decade, around 2012, when the mining boom was going exceptionally strongly. So if we were at 5% unemployment before the pandemic and we had wages growth barely half that, well, we're 6.5% now. And just this morning, the governor's hinted that their measure of full employment that might be required to see wages growth get back to that 3.5%, 4% level could be well below 5%. It could be 4% or possibly even lower.
Just the NAIRU.
That's the NAIRU measure. So the non-accelerating inflation rate of unemployment. So in other words, the point at which there's no slack in the labour market and pricing power returns in terms of wage negotiations. Now, do we think in the next 12, 24 months we're getting down to a 4.5% or lower level of unemployment? I think that would take a minor miracle. And therefore, the recent sell-off in bond markets has probably been a bit too optimistic, really, in terms of that shift.
Has that NAIRU ever been hit? I'm sure you keep on top of the MMT and modern monetary theory, where basically they're targeting full employment, and if inflation comes, it comes.
It's a bit of a theoretical concept. It's a bit like driving in the dark without headlights. You'll know when you hit a brick wall when you do.
Yeah,
but
it's not automatic.
Yeah, that's right. So until you get there, you can really only theorise about what that might be. And let's remember that in the United States, unemployment got down into that 3% range in the last couple of years before the pandemic. And they still didn't really have a lot of wage inflation. There were some signs that it was maybe starting to just appear. So, equally in the United States, the chairman of the Federal Reserve, Jerome Powell, estimates that real unemployment at the moment is around 10%. For them to get back to unemployment levels that they had pre-pandemic requires monthly job growth of 700,000 every month for the next 2 years. Last Friday, that particular statistic was around 360,000. So this is not a 1 to 2 year post-COVID recovery. It's going to take a bit longer.
And what if they're wrong? What if all this money printing for 12 years that we've been talking about, we said higher interest rate 10 years ago, didn't we, Jamie? And we do get
2009 when we started this concept. There's too much money, too much wood being thrown on the fire.
Well, see, I think that's the really interesting thing. That's the thing that is different this time, that is perhaps a bit more experimental, and to be honest, probably where we are more concerned that we could see inflation emerge because of this combination of very, very easy monetary policy, quantitative easing, where central banks are basically pushing more money into the financial system, and governments are on the other side borrowing more money to target certain parts of the economy. So in the United States, the size of fiscal deficits is substantial. It looks like it's going to stay that way for a long time. That's different to the behaviours we saw in the pre-pandemic, where fiscal policy was being used far more judiciously. Does that lead to a quicker resumption of inflation? I think is a genuine question.
What would you need to see to be concerned? A couple of 1 quarter. Everyone seems to assume there'll be a quarter of inflation because things like restocking or everyone's been running down their inventory to maximise cash flow. Is one quarter you'll forget about? And do you need to see multiple quarters of increasing inflation? Is that what would really trigger?
Yeah, I think you need to see multiple quarters, and I think you need to see it accompanied by the labour market really starting to show signs of running, at full capacity.
So we're talking about higher inflation leads to higher rates, essentially, and so you're not subscribing to higher inflation, so not higher rates. How would you position your portfolio if you thought, or how should one think about their fixed income portfolio if they see inflation being sustained at 4 to 5% for 5 years? It's a totally different way to approach portfolio management, I assume, in your world than it would be if you're seeing rates go sideways.
It is absolutely, Jamie. If we think we're going to start to get back to those sorts of levels, then you want to have a very different portfolio, a very different approach. And the whole inflation concept has been theoretical rather than real for decades, really, for all of us. Across asset allocation, it's kind of been in the background but never been a problem. So getting back to 4 and 5% is a complete reversal of what's worked for bond portfolios in the last decade or two. If you go back to the start of the last decade, say 2010, the average yield to maturity on the domestic bond market was 5.5%. Inflation was running at around 2.5%, 3%. So your inflation-adjusted yield was already 200 basis points above inflation. Here we are today. The average yield across the index is barely 1%. So it doesn't really take a lot to envisage inflation even getting back to 2%. You're minus 1%. So we need to start with the stance that recognises that even though if our view is correct, real demand-driven inflation is probably still out there rather than an imminent risk. We don't have a buffer in the market to deal with that if it arises. So the way we would suggest clients manage their risk portfolios in bonds is to be looking for active solutions that basically can take advantage of those mispricings along the way. So to give you an example, we may start April this year with a bond rate that's 1.5%. We might finish calendar 2021 with that same instrument at 1.5%. But within that period of 9 months, it might range within 50 or 100 basis points as it tries to adjust to different expectations. And that's where you can make money, by positioning around that volatility. So rather than just buying, owning and forgetting in a sort of passive way, being active to look for mispricings relative to what you think is going to transpire is the way to add value.
So active and shorter duration.
Correct, yeah.
What about inflation-linked bonds? They've come up a lot in the media. Would that be essentially, could you consider a long holding an inflation link? Say, I think New South Wales Treasury's got their T-bonds that go out 25 years, and the income obviously increases by inflation each year, and maybe the capital does as well. Is that how inflation-linked bonds work?
Yeah, so the capital value of the bond is adjusted for inflation. So you have some protection against headline inflation moving higher over the period. The problem with inflation-linked bonds is as you point out, they're very long-term to begin with, and they still have duration risk, but it is inflation-protected duration risk. So if real yields increase, which they have been in the last few weeks, then you will still suffer losses even on an inflation-adjusted basis. So the way we like to look at that is the relative value between inflation-linked and nominal bonds. That difference is the implied level of inflation that the market is projecting, and actually look at that as an active source of potential return in portfolios. So, as an example, sorry, if I could just make that a bit more real, going back to first quarter last year when we had the sharp descend into the pandemic-led sell-off of stocks and commodity prices fell, that difference between nominal and real bonds, inflation plummeted, of course, as everyone panicked about the outlook, commodity prices fell, etc. And, that was an opportunity to actually position for a recovery in inflation expectations, which we, in fact, were able to do from very extended, levels lower.
This is less about inflation, just more about your active management. You were saying if you had a bond, you bought it at the start and it ended at the similar level, you potentially have the opportunity to buy and sell the same bond over the period of time, higher and lower prices. But does it make sense if you think that, rates potentially are going to fall off even from a low point, they've climbed quite steeply, to buy a longer duration bond rather than the same bond again?
Sure. Yeah.
So
the way we like to look at the bond market is at different points in the yield curve. So basically the yield curve starts at zero or cash and then goes out as far as instruments exist. So in the case of
100 years now, is there?
There's 100 years overseas. The Australian government, you can certainly go out 30 years. So that's a long period of time, and then anywhere in between. And the longer you go on the yield curve, the different the forces are that come to bear in terms of the price or yield. The shorter you are on the yield curve, the closer you are to short-term expectations for changes in monetary policy. So the way we like to look at it is if we have a different view to what the market does in terms of the outlook for Reserve Bank monetary policy, then somewhere in sort of a 3, 4, 5 year part of the yield curve is an interesting place to position, because basically if our view turns out to be correct, then we can clearly map excess return according to the monetary policy path. If we're buying a 10, 15, 20-year bond, then the impact of those short-term policy expectations kind of diminishes and you become more beholden to the forces of global bond markets, longer-term inflation expectations, risk and liquidity premiums, et cetera, et cetera. So if we think about at the moment where the Reserve Bank of Australia is doing yield curve control from a 0 to 3 year time horizon, they're basically saying over 3 years, we will keep the government bond yield curve at or around the cash rate of 10 basis points. And then anywhere from 4 years onward is kind of like market determined to a degree. But it's in that 3, 4 year crossover area that the market has all of a sudden started to price lift off from this easy policy very quickly. And so if you disagree with that perspective, you can buy securities in that part of the yield curve. And as the market changes its view, then you'll either make or lose money.
I usually go with the concept if it's on the front page and sounds like it's a certainty, it's not.
Sure.
Like today, when inflation's on the front page of the paper, you kind of start to question whether it's really as bad as what you think when it's making headlines. We talked about US and Australian inflation. Do you look at the broader base out there? Do you look at what's going on in Europe and in parts of Asia as well? Are you able to hold global bonds?
We are. So we're looking at a number of markets as investment opportunities we think make sense for our clients. So certainly within Australia and New Zealand, we've had exposure in some of the higher quality parts of the Asian markets. historically, and indeed we own some bonds from there at the moment. It really just depends on where we think the best opportunities are for local clients.
Just trying to pull the trigger away from long duration, isn't it? Whereas if you're following the index, you're stuck at 60% US, probably treasuries and 6-year duration.
Correct.
And you're trying to be flexible around that and remove the risk of higher interest rates or have exposure to different economies.
Correct. Yeah. I mean, I would say, I mean, the inflation story, which you've really rightly highlighted, is an important theme for this decade. So on the one hand, I've suggested the market is perhaps getting a little bit too ahead of itself in the short term about worrying about a big breakout in inflation. But I do actually very much believe this is the decade when you need to be focused on that, because even though in the short term, given what the key signposts are for central banks on that, we don't think that's coming this year or probably next year. At some point over the next 5 to 10 years, this could all go wrong in terms of fiscal and monetary policy colliding with some other forces to see just inflation appear, perhaps unexpectedly. And so, I do think this is something that we need to have in the back of our minds, perhaps even from unexpected sources.
So if I think that's right from an investment advisor's perspective, and we build multi-asset, multi-manager portfolios, then inflation is important that we don't get it wrong. If we were sitting here today and you were saying, hey, I've got duration sitting at twice the index at 12% because I think rates are going to go sideways or go down, then we would have bigger concerns. We probably wouldn't be using it, to tell you the truth. But then it also applies in different parts of portfolios. So, do we have inflation hedges? How are we holding the equity exposure? How are we holding our infrastructure exposure? And infrastructure is an interesting asset to talk about inflation, because even though the real asset value should go up, they hold a lot of debt that potentially needs to be repriced at some point. So we're coming from a slightly different perspective, where we're managing retiree capital mainly, and the last thing that we want is high rates to be higher, even though it might be a lower risk and adversely affect the carrying value or the permanent value of clients' portfolios. That's why we see it as a big theme. That doesn't mean all themes that we're doing a series of 12 of these, and lots of themes in here are like cloud computing and programmatic advertising are all kind of how do you grow your wealth over that period of time. We see the inflation is just, again, the boogeyman that we just don't want to let out and have adverse effects on portfolios, including the fixed income component.
And I was just going to ask before, maybe it's a bit too close to home. If you're a central banker at the moment, what policies would you be pushing the same policies that are being implemented? Doubling QE, keeping rates lower. I understand it's a lot about confidence, so having businesses and people confident to spend.
Yeah, that's an excellent question. Yeah, it's hard to prove the counterfactual. Okay, so I mean, we have the policies we have, and so growth and recovery at this stage of getting through the pandemic kind of looks okay. So it's kind of hard to say, hey, they shouldn't be doing QE or rates should be higher, as tempting as that is. I do think it's
hindsight, isn't it?
It is. I mean, it is interesting that the Reserve Bank here in Australia did pivot fairly quickly from being very cautious, if not negative, on QE as a tool here, to then starting to do that late last year, and now we're in QE2 and discussion in the morning, don't rule out QE3. And I think the clear trajectory is, if you look around the world, as central banks start to use these tools, they become stable in the toolkit, and it's not easy to actually reverse those policies.
It was a very quick pivot, wasn't it?
It was a quick pivot. And, in fairness, and John Maynard Keynes said, when the facts change, I change my mind. So that's probably how Governor Phil Lowe would defend it as well. And look, it's hard to be critical of authorities who are trying to fight a very devastating pandemic-led recession and just throw the kitchen sink at it in a quote-unquote Team Australia collective approach. It's Australia's probably had a good experience in terms of our ability to weather this storm. So, but I do think extricating yourself on the other side from this sort of expansionary policy is extremely difficult, as we've seen around the world.
We're having a quick chat about property beforehand. I know it's not your specialty, but there's some talk about property bubbles being inflated by interest rates. Is that an economic concern? Will that be the driver that sends rates higher, bonds lower, equity market volatility? I think the New Zealand Central Bank tried it.
It's been a fascinating couple of weeks because what's been happening here in Australia with property prices going higher has been the case in New Zealand and some. And so property prices have been absolutely on fire in New Zealand. And the government and the Reserve Bank over there have had an interesting few weeks where the government's actually changed the mandate they give to the RBNZ and said you need to take into account house prices when you're setting monetary policy. And unlike in Australia, the Reserve Bank of New Zealand is responsible for both monetary policy but also macro-prudential oversight of the financial system, which kind of APRA in Australia would do, but they have one body. And so the Reserve Bank said, well, we already take property prices into account, go away. And but it's a very political issue. Housing affordability is a political issue. And so with house prices going up, well into the double digits, everyone starts to get worried. But the Reserve Bank Governor, Adrian Orr, was very clear they will not use monetary policy to blunt house price growth. They have macro-prudential measures where they can change caps on borrowing, maximum loan-to-value ratios, etc., to try and cool that. And he also made very clear that some of the surge in house prices in New Zealand, which I think is also true in Australia, has been driven by the fact that there's been a lot of Kiwis who've come home in the last 12 months, a lot of Kiwis who haven't left, as has been the case here, and they've all gone out and bought a home, or not literally, but a lot of them. So there's been a lot of one-off demand, which has, driven a supply-constrained market higher, but that is not going to be continued, into the future. It will kind of start to fade as a driver. So, and Governor Lowe just finally in his speech this morning made very clear they will not, to a large degree, I won't say they don't care, but they are not going to move monetary policy because house prices are going up.
Fascinating. And something like wage growth that you mentioned earlier could help as well.
Yeah, I mean, wage growth is really the holy grail that they are seeking. And, in terms of house prices and that dynamic of the economy, and the challenge is we went into the pandemic in Australia with the second highest household debt to GDP in the world. We had very high house prices. Clearly, the last 12 months created a lot of uncertainty, but you kind of look back and go, well, what housing crisis was there? I mean, we've kind of sailed through and things look to be in incredible health. And credit growth, house credit growth is accelerating rapidly again. So we've got this combination again of very, very high debt levels at the household sector, extremely low borrowing costs. That makes the ability to service that debt more manageable, which means households can borrow more, which they are, which kind of in some ways reinforces the need for monetary policy to stay easier to sustain that, all other things being equal, until income or genuine household growth starts accelerating and we can kind of handle or manage interest rate increases.
Do you think about in wage growth, when I think about wage growth, I think as an employer, things like AI and technology and leveraging, or kind of thinking about how I leverage my workforce smarter. So that kind of leads to less pressure on us to push wages up. And just the way we're delivering this today, no one really knew what Zoom was. If we're on Zoom, I think we're on Zoom 18 months ago, where now it's, the think about the amount of people that this would have required to film and to distribute. So it's easier for us to leverage things rather than wages. And that seems to be a trend going forward. You know, people are deciding to work from home, work offshore. AI is taking over a lot of the roles, and we're seeing it in our little business. So do you think about that when you look at the traditional numbers? I mean, you're more or less a portfolio manager, economist gets a set of numbers, and those numbers get influenced by, you know, thematic changes like AI. And
I think technology that's kind of taking out various parts of, you know, workforce functions that we might have done historically using labour. It's definitely deflationary. It's been deflationary. I think it was the consultant Bain and Company did a study showing that over the next 10 years, like 30% of all jobs in the US will be impacted by technology in some form. And that's not to be kind of alarmist or feared per se. It's just a transition that we'll go through and we'll navigate, but it is a deflationary headwind. But then there's another aspect of technology, which is productivity enhancing. So, you know, that could be positive for wages growth. I mean, I use the example with my son, and, you know, he's an economics student trying to explain this. If he's a barista and he's making coffee and he's using just an espresso machine or some basic unit, he can only make 20 coffees an hour. Then we invest in a better technology coffee machine that enables him to make 50 coffees an hour, and he's more productive, and that's driving profits at the business. Then, you know, his ability to earn more as an employee because he is more productive is increased. So to the extent that technology helps people be more productive and drive profits at the firm more, then, you know, we should look forward to that.
Then the profits are spent in the economy anyway. So
correct. But I agree, Jamie. I mean, a lot of the easy low-hanging fruit in terms of tech evolution has just been to take out, you know, basic functions from different workforces pretty easily.
And you have, I think, in your weekly or monthly update, you're talking about investing for what the period you expect, not what you hope for. So you're kind of expecting, you know, maybe a boost in inflation, but not extended for a period of time. What do you hope for? Is that, you know, a strong economic recovery, huge volatility?
Yeah.
You want the long duration managers to lose, or?
Yeah, I don't worry. I mean, we don't worry at all, to be honest, about our competition. We're just too focused on what we're trying to do for clients. I think what we hope for is that basically this pandemic is truly now, well, the worst of it is behind us. So from a more, you know, for the betterment of society type perspective, that we are in a much more of a normal playing field in terms of being able to live our lives, not being fearful of substantial outbreaks, lockdowns, etc. And so, yeah, that's one point. But we're ready for any outcome. I mean, we are ready and are able to shift what we're doing in portfolios according to what we think is likely to transpire, not what we sort of hope for. You know, it does warrant a mention because it's just been so important, unfortunately, for trying to figure out how to manage client money, is what is the outlook for the pandemic. And, you know, we do think the worst is probably past, but the consensus view seems to be growing that we shift from a short, very material pandemic to one where the virus becomes more endemic. So in other words, we're not likely to eradicate this in the globe, but we are likely to see it just bubble away and learn to live with it. And hopefully
that's the big unknown, isn't it? It's a big unknown.
Yeah. I mean, if you look historically, correct. And I'm not an expert in this sort of medical science, but, you know, historically these big pandemics, you don't really eradicate them. They just, you know, the virus loses potency over time, or the variants that start to emerge become less dangerous, and it kind of just becomes more of a seasonal flu eventually.
Like the flu, yeah.
Yeah, but how long does that take? You know, is that 1-2 years, or is that a 5-year process? We'll have to wait and see.
Yeah, something we talked about once, this is a bit off track, Andrew, but we talked about once before is why we like your group is essentially you're a small business within a bigger business. And recently, Franklin Templeton acquired Legg Mason. And along with you guys, some of our other favourite bond managers, so Western and Brandywine, are there. Do you get to talk to them a bit more closely than you did before, or are they still lots of Chinese walls up between the two groups or three groups or four groups? There's lots of groups there now.
There's complete Chinese walls. I mean, really what Franklin is now, and kind of was, but certainly is now, is what Legg Mason certainly was, which is an owner of different investment companies, of which we're one. Western Asset is another, Brandywine is another, and there's quite literally no interaction between us and those investment teams. So,
That's a pity. It'd be fascinating to get you all in a room. Maybe we can organise that, Drew, at some point.
We have to have some Kevlar vests.
Yeah. Competition's good.
Absolutely.
So, all right. I think we've been going for our allotted time. Drew, do you have any questions or queries, or do you want to add anything?
I think I've extinguished all of ours. So I think probably the takeaway is inflation isn't, there's no certainty, and it's kind of a moving beast, as you said. It'll mug you one day, then it'll be gone the next day. So
I had another quote actually from Leon Henderson saying having a little inflation is like being a little pregnant. So we'll see. Time will tell. But really appreciate your time, Andrew. Once again, you've taken time out of your day to speak to us. You've shed some light for our listeners about inflation and how your fund is playing it. Thank you on behalf of Drew and I and Wattle Partners. Really appreciate it.
Thanks, Jamie. Thanks, Drew. Really, really appreciate the opportunity.